Everyone, welcome to our 2024 Midyear Outlook video, Still Waiting for the Turn. Stay tuned. Before we dive into stock and bond market outlooks for the remainder of 2024, we have to take some time to look at the machine that powers all of it, the US economy, which continues to be pretty resilient in 2024. Look at the last couple of years. We had 40-year highs in inflation numbers, which led to a very aggressive interest rate hiking campaign undertaken by the Federal Reserve. We've seen calls for mild recessions and deep recessions. And through it all, we've had an economy that just keeps moving forward. We still have very low unemployment. On average, we have consumers that have pretty healthy balance sheets, and we see consumers continuing to spend money. Take a trip to virtually anywhere in the United States, and you're going to find airports that are full, hotels that are crowded, and even like your local restaurant, it's probably still pretty crowded on a Tuesday or Wednesday night. Now, that's not to say there aren't cracks in the armor and there aren't indicators that are showing an economic slowdown. That's what we anticipate in the near term. It's hard to keep interest rates this high for this long without seeing a bit of a slowdown. But we don't think that needs to signal some sort of run for the hills type scenario where we spiral into a deep recession. It can be part of a healthy, functioning economy to go from a red hot economy to an economy that's still pretty good. So that's what we anticipate happening in the near term. During our 2024 outlook to start this year, we said that we were optimistic on the stock market. That's turned out to be correct so far, especially as corporate earnings have continued to exceed expectations, which has led to strong market performance in the first half of 2024. But election years tend to be very volatile, and we just haven't seen much of that volatility so far this year, with just one 5% pullback in the S&P 500. The stellar first half of this year, paired with the lack of volatility, leads us to believe there's likely turbulence ahead, despite being optimistic longer term. Stocks tend to perform well during Fed pauses. The Fed is currently in an interest rate pause defined by the time period between the last rate hike of a cycle and the first rate cut of the next cycle. The current Fed pause at 331 days is the second longest in modern market history. The S&P 500 has risen during 5 of these 6 pauses, with an average gain of about 13%. The 2000-2001 pause was the only one where stocks fell. The S&P 500 lost 7% during that pause, which was marred by recession and accounting scandals. Since the current pause began, after the Fed last raised rates on July 26 of 2023, the S&P 500 has produced really strong returns. If this monetary cycle is comparable to those in the past, then stocks may struggle to add much, if any, to first half gains over the next several months. Next up, Jim Sr. will discuss U.S. elections and the bond market.
Jim and I have often said, don't mix politics with your investments. This slide represents why. If we had $100,000 that was invested back in 1950, it would have grown to over $32.5 million if it was just left alone. However, if someone wanted to invest only when there was a Democratic president in the White House or a Republican president in the White House, we had very different outcomes. You can see down here, the blue line represents when a Democrat was in office over time, that 100,000 grew to just slightly over 3 million, and under the Republican presidency, just a little over 1 million. The outcomes are typically very similar, either Democratic or Republican presidency. In looking at this chart, the difference can be accounted for 1 year in 2008 when we had such a massive decline. But the moral of this story is the markets typically do well regardless of who is in the office on a longer term basis. So keep that in mind when you're investing. Let's take a look at bonds and we'll wrap it up just in another minute or so. The income on bonds are certainly higher than it was a few years ago. In 2022, we had the worst bond market on record, and that was due to the rise in interest rates. Last year, we had volatile interest rates, and so the first half of the year was not very good for bond values. And then really the last 2 or 3 months, rates came down and bonds did well. So we had a pretty good year last year. We think that's how this year plays out as well. Our treasury, 10-year treasury started out in January under 4%. A few months ago, it was as high as 4.7%. Today, as of this recording, it's under 4.2%. So bonds are positive year to date. We think as we go out towards the end of the year, we're going to look back and see that bonds had a pretty good total return this year. That's our opinion. We think next year it'll be the same. As long as we're not in an environment where we have rising interest rates, and on a short-term basis, anything happen. But looking out, we see the trend as being down, maybe not as much as people anticipated a year ago. The economy is still pretty strong, and so we may not see rates go down significantly, but we may be in a trading range similar to what we said at the beginning of the year in our outlook, somewhere between 3.75% and maybe 4.25%, that type of a range. Unless we go into recession, then we'll see interest rates go down even more so. So we're optimistic both on stocks, as Jim talked about, and we're optimistic on bonds as well going forward. It's an election year, and in the next coming months, we might see some volatility. Please, if we do see turbulence, be patient. Continue to think a little bit longer term and keep the faith. Thank you so much for tuning in. Again, call us if there are any questions that you have.
Please take a moment to review these important disclosures.